The consumer stocks now. Abneesh Roy, Executive Director at Nuvama Inst Equities, joins us now with his call on consumer companies and specifically his call on HUL. Abneesh, thanks a lot for joining in. Appreciate your thoughts here. I wanted to talk about HUL's recent commentary where they spoke about how the urban demand is resilient, but the rural demand is also showing some gradual improvement. So it looks like everything is coming together. Your thoughts on what this could mean for consumption companies over the next, say, 12 to 18 months, and what's your pick of the pack?
Sure, thanks. Our current topics will be more urban-focused companies or where there is a leadership change which is driving a lot of transformation and where there is a correction in the key raw materials. Our topics currently will be Nestle, United Breweries, Tata Consumer, and Colgate. Coming to Hindustan Unilever, in Q3, we expect that the status quo will largely remain. Rural demand continues to remain a challenge for most of the companies, including HUL. So basically, there is also local player competition, which started, say, in Q2, in terms of the lower-end detergent and tea. That will continue for 1 or 2 more quarters. Also, the gross margins will dip a bit quarter on quarter. It will improve YOY. EBITDA margin and gross margin, but quarter-on-quarter slight dip will be there because if you remember initial Israel-Hamas crisis, the crude had jumped to 95. But in Q4, Hindustan Unilever will see expansion in margins. So Q3 bit muted, but in Q4, the margin recovery will start. And FY25, Hindustan Unilever should see positive pricing coming back. Q3, the pricing for HUL is likely to be slight negative and volume growth also muted. It will be a growth. So overall, currently, urban-focused companies are growing faster. Rural continues to remain a challenge for most of the FMCG sector. Paints and jewelry has seen a good Q3, good festival demand. So those are the companies which will do well in Q3.
Abneesh, hi, morning. You mentioned United Breweries. You know, its stock's done nothing this year. It's been flat for the last 4. We had the management, the new CEO and MD with us 2 days back. And they basically told us that industry is growing at 5 to 7%. They should outgrow the industry. Premium segment will grow much faster, where they've kind of struggled. You know, across not just UBL but across the category, is it just a relative kind of call now that stocks have not moved, valuations have not come off, but stocks have not moved? So maybe money will rotate into these names, or is there real growth excitement here in the space?
Good question. Yes, there is a real excitement because from Q3, you will see the gross margin and EBITDA margin see further recovery because the high-priced inventory of barley, which was a challenge because of the Ukraine crisis, that got over in Q2. The new MD is not just focusing on premiumization. He's very clear that the lower end also has a huge opportunity in terms of revenue and profits. So that will also lead to better volume growth. If you see even in Q2, the premium volume growth was 10%. You're absolutely right. In terms of premium market share, UBL is under-indexed. The other MNCs are much larger. If you see pan-India market share for UBL is around 50%. But in terms of the premium, they are below 20%. So there is a huge headroom to catch up. Our sense is next 1 year, because of the new MD's much higher focus on aggression, innovation, new launches in the lower end. And even in the premium, Heineken has come out with a new draft beer, and they are going to have manufacturing in Karnataka. Our sense is the volume growth should become high single digit to double digit. Definitely in premium, it will be double digit, and gross and EBITDA margin expansion. So yes, UBL is not just a relative, it's an absolute also. The leadership issues have been resolved. The gross margins are also expanding.
Okay, Abneesh, got that. So you gave us a sense of the consumer names. I want to just kind of talk about one more name, specific name, Z, I think, where you have coverage. Stock is starting to show some excitement here. What are the next triggers? And, UBS a couple of days back had a call out where they said that sort of the broad thing was that they're not very positive on advertising revenue picking up. Not just for Z, they had, I think, Sun also as part of that note. But for Z, what's the big trigger? I mean, next 2 or 3 things which should work out if you have a positive view here.
We are positive. I think the biggest trigger should be the still slight confusion on the merger in terms of who will be the CEO between Z and Sony. I think discussions are on. I think that will be a near-term trigger, and we are seeing that the talks are happening. Media articles were saying that the breakup phase is there. As per our understanding the discussions are happening and it is going in the right direction. Coming back to your question, advertising clearly, if crude is at a 1-year low, that's good for advertising because FMCG companies will see expansion in margins. Q3, as I said, HUL and a lot of FMCG saw a temporary blip when the results come out. But in Q4, that will be again back. Most of the recession is driving commodity deflation. So that will give more gross margin expansion for FMCG. Subscription also, if you see, should come back to that high single digit kind of a CAGR because the legal issues have been resolved. Plus, once the merger happens, there will be synergy benefits. So 3-4 things are there. But currently, the big trigger will be the confusion, which is still there slightly in terms of CEO. We are awaiting clarity on that.
Okay, that's on Z Entertainment. Well, do you track Nykaa by any chance, or any of these platform companies that have been doing quite well and have, sort of come back to profitability, or at least on their path to profitability? Anyone that you would put in your portfolio now?
Yeah, I think Nykaa is something which we discussed last time. The stock has given a decent return post that also. In Q2, the good things were fashion grew very strongly. And now Q3, if you see festival season, the company is taking corrective action there. In terms of beauty and personal care, also what we are seeing, there is a rational competition now. So irrational discounts, etc., reducing. So I will say yes, definitely Nykaa is looking like a good re-rating story from a 1-year perspective. Q2, we saw some evidence of that. But ultimately, sustainability of the fashion growth, which has been a key challenge, that is one more important thing. But in the core beauty business, clearly Nykaa is doing quite well. So we are positive on that company.
Okay, all right. Always good hearing your thoughts. Abneesh, appreciate you joining in and filling us in with your take on various stocks. Wishing you a good day ahead. Well, let's go back to